You're watching Stock Watch. I'm Zinati Guma, and joining me to unpack your stock-related questions today are Pierre Verster from Protea Capital Management and Ricus Reeders from PSG Hole in Ruimsig. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Thank you so much for your time today, gents. Quite interesting moves that we are seeing on the JSE. Before we actually get to the questions, I want to talk about Northern Platinum because usually when a company releases a trading statement after market close, a lot of the time you know that there's something wrong. So they released their trading statement, I think, at 5 p.m. yesterday, and then investors coming in and reacting. That share price down 8% on the day. I mean, in a time, JP, where PGM miners have actually been gaining a lot, what's, I guess, spooked investors on Northern?
Good evening, Zinati. So basically, it's the basket price of what they sell was lower than expected, which means that the headline earnings per share guidance that they gave was below expectations. Now, most of the strong rise in platinum, palladium, and specifically rhodium happened after the end of June. So at least we know that going forward, the prices will look better in the next period, and that will boost them going forward. But backward looking for the period till the end of June, it was disappointing. That is why the share price was lower, but it's still up by a substantial amount of over the past 6 months and over a year. I think it's up by more than 60%. So it has run hard on the back of higher PGM prices, but today indicates that both Northern and potentially the other platinum miners as well, or PGM miners, have actually run ahead of the PGM spot price. And they all are quite full, in my opinion, at current prices.
Yeah, very, very interesting, because just now we're thinking that they were out of the woods. Is that not the case, Ricus?
No, I think certainly with their basket price being where it is, earnings going forward should be okay as long as as the basket stays where it is. But at the moment, precious metals are basically moving sideways. I mean, gold is, for the past 5-6 months, basically we're at the same price. Platinum, similar, although not for that long a period. But as Jean-Pierre said, I think on the platinum side, those prices for the miners seems pretty full at the moment, and I think they need to consolidate the price gains they've had over the past couple of or number of months. And with Northern specifically, operationally probably not doing as well as the market expected. I think Fontaine, they specifically up their costs somewhat. So they're in for a period of consolidation. I'm not saying to sell them at the moment unless we see a real drawdown in platinum, rhodium, palladium prices, which I don't really expect at the moment. So that's the story there. The initial gains have been made, and that whole sector needs to consolidate gains.
All right. I hear you, gents, on that. Well, let's move on to the questions. Quite an interesting one here. I want to get exposure to Naspers or Process. I'm not sure if I should buy directly one of the two, or the top 40 index for diversification. Which one makes a better investment case? Buying Naspers or Process, or the top 40? So individual, JP, or the whole top 40, where they do have a significant contribution in there?
Well, the significance of that contribution, or the weighting in the top 40 index, has actually shrunk over the last few years as they continue with their share buyback, to the point where it's not even the biggest constituent of the top 40. Richemont is now the biggest constituent of the top 40. So if the viewer wants exposure to Naspers and Process, I think they should buy Naspers and Process. There is diversification within their portfolios, the companies' portfolios, even though it is dominated by Tencent. But then if you look at Tencent, they themselves have got quite a diversified portfolio if you look at all their investments that they have in other companies. So the biggest chunk of their business is still computer games, and another big chunk is Weixin, the all-in-one app that's ubiquitously used in China. But they've got a lot of stakes in a lot of companies as well. So if you really look through to what you're buying, I think you get a lot of diversification buying Naspers or Prosus. And between the two, my preference is for Prosus.
Okay.
The discount that Naspers trades to Prosus has narrowed sharply, and Prosus is a more tax-efficient vehicle. Your distributions is a return of capital, not a dividend. So for an individual investor, at least, you get a little bit more out after tax by owning Prosus than what you do by owning Naspers.
Okay, that's an interesting point that you make there, that if you want Naspers, just buy Naspers or Prosus, because the top 40 actually has the biggest weighting is Richemont. How would you be approaching the top 40 at this point, Ricus? Would this be something that you would consider buying at this point?
Yeah, I would rather go and see what the specific weightings contributions are towards the top 40, and it's still very heavily weighted in the top five or six shares. So I'd rather go and stock pick amongst those than just buy the top 40. And the reason being because there's such a mixture of both growth, in the form of telecoms, if you want to classify telecoms as a growth sector, Naspers, and then on the other side you've got all the resource stocks, which at times form a big part of the top 40, and at times not, depending on where you are in the cycle. So the top 40 as a diversification machine doesn't make sense to me, because it is composed of such an amalgamation of bits and pieces which can change as far as weightings are concerned, depending on where you are in the resource cycle. It doesn't make sense to me. And I think it's also just from managing portfolios with individual shares. The top 40 doesn't really make sense. I'd rather go and focus.
Okay, all right. Well, there's a question here. I have 16,000 Rand to invest in a tax-free savings account. What is the best choice? Satrix Fini, Satrix China, or Satrix Resi? JP, so exposure into the financials, or exposure into China, or exposure into resources?
So normally I would say I prefer to pick stocks to an index, but if you only have 16,000 Rand, your costs are going to be very high if you buy individual shares, because let's say you want to buy 10 different shares, and you want to put a tenth in each. That means your total purchase per share is only 1,600 Rand. And some shares are even trading above that for one share. So yes, I think an ETF strategy in this case makes sense, seeing that it's a relatively small amount. And between the three ETFs that you've mentioned, I would probably prefer the FINDI, which is financial and industrial stocks.
Okay.
I think our financial stocks on the JC, specifically the banks, are offering good value at the moment. And on the industrial stocks are the likes of Naspers, Prosus, Richemont, etc. So you get good diversification. And I'm not a big fan of commodities. So it actually is almost like buying the top 40 excluding commodity shares.
Okay.
Which is something that I would prefer. The China ETF is too focused just on China. And the Resi is obviously the missing part if you buy the FINDI when compared to the whole market, because the FINDI plus the Resi is effectively equal to the market, the top 40. So I would go for the FINDI.
Okay. Yeah, your pick there, Ricus.
Yeah, I mean, if it's a tax-free investment, by definition, this is a long-term play. Long-term, nobody needs resources, because you're always going to get back where you started off from at some point in the cycle. It doesn't make sense as a long-term investment. It's for trading. China is uninvestable. It's eminently tradable. But I don't want China focused, because you've got no idea what government's going to do. So for the longer term, just buying and holding, you don't know what you're going to end up with. China, very tradable, not investable. So your Findy locally is the safer bet over the long term. And if you really want to go offshore, I think Japan is a very interesting play because of an aging population and a generational transfer of wealth that's going to happen in that country as the old people die off and they leave their money to their children, which have a very different way of saving than their parents had.
Okay, very, very interesting. Well, as we're talking about the financials, the banks, JP, what's your take on the sector in a year or two? What would be your buy, hold, sell, and why?
So if you say financial sector, that normally includes life insurers and banks. Within that, I see a lot of value in the banks. And between the banks, I like all the banks.
Okay.
So it's tricky. If you tell me I have to choose one, sure. Potentially at current prices, I would say Standard Bank is got a good balance between growth and high current returns. The valuation or the price is a bit higher on a price to book basis than the other universal banks. Capitec is a little bit on the expensive side for me currently, even though much higher returns, higher growth. And then Nedbank, I think also looks reasonably, but then First Rand also looks reasonably if they sort out the UK situation, which is close to that. And then why don't you buy Absa as well? Because it's trading at a discount to NAV. So that's why I say all of the banks I like at current price.
SA banking sector, Ricus.
Yeah, I know Capitec is expensive, but I still like Capitec just because of its growth profile. First Rand has got most of its UK problems sorted out. It's now, the problem is to find all that remains is how much they're going to pay to solve that problem. But that has gone from quite uncertain to a little bit better. So I still probably prefer First Rand as over Standard Bank, but really there's no choice between the two. Absa and Nedbank, I still think, even though they might be valuable on a fundamental basis, I don't like their growth profile. So they would be the third or fourth and fifth in line.
We've been talking a lot about the financial sector counters. There's one here specifically for Momentum. I like their results and I believe the company makes a great investment case for the long term. The question is, on a PE of 10 times, is it a good time to get in or has the share price rallied too much? Ricus, Momentum.
Well, let me punt the company quickly, and this is just anecdotal. I had to deal with Momentum, and I'm not a client of theirs, and I don't have it in my portfolio, but I had to deal with a helpline from Momentum a week or so ago, and hell, they were good. I was really impressed.
Okay.
And I think maybe the market is impressed with them as well. But if you compare what their price has done versus the likes of Sanlam Old Mutual, it's done very well. And operationally, as I said, I really don't have an interest in the company, but I've been looking at it and thinking, well, as far as executing operationally what they've been talking about, they've been doing it. So it's certainly one that piques my interest, but I don't know enough about the company yet to say, well, go and buy it. But as I said, just from personal experience, looking at the share price and knowing about their results, it's certainly from the on the insurance side on the JSE, it looks quite interesting.
Yeah. And actually, I mean, the insurance sector is not really the most loved sector at all times. No. But JP, is Momentum just outperforming at this point?
Well, the share price has done very well over the last, say, 5 years or so. That's mostly since Jeanette Marais and Risco Katola took over as CEO and CFO respectively. And they've done a very good job to effectively go back to basics and focus on returns. And that has really delivered a big re-rating for shareholders. I think most of the low fruit has now been plucked. So it is going to be difficult from this stage on to do better than their competitors. But they do have a good position. And I agree with Ricus, also good customer service. So I think one should keep your eye out on the Indian ventures. They've got some investments there, which could be high growth. And so I like it. Generally, I'm not a big fan of the life insurance industry. I like the short-term industry more, Outsurance and Santam. But Momentum has done very, very well, and I think it's a solid business, and it's not too expensive at the current share price.
All right. Well, let's actually go into US tech. I'd like your view on the S&P 500 Info Tech ETF and its level of volatility. Would you recommend it for a 5-year period? Ricus, is this ETF at all on your radar?
If you don't mind the volatility.
Okay.
Remember, I mean, when was it, Jean-Pierre? About 2 years ago, 2022, we had about 25-30% drop in that sector, and they've recovered and rebounded and surpassed again. So there's going to be volatility. At the moment, I was reading a stat this morning. If you have an index of loss-making infotech shares over the past 6 months, they're up about double figures. I mean, I can't remember, but an amazing amount. So your retail investor is chasing momentum in that sector again at the moment. So what's it going to look like 5 years from now? I don't think the interest in that sector is going to wane, but be prepared for a lot of volatility. And if you can live with that, and you're buying right now, and it might be at a very short-term top, brace yourself for losses along the way. But I still think, specifically with the development of AI, you have to be exposed in some form or fashion to that sector.
Okay. JP, hold on this for 5 years?
So I don't know the ETF that well. I don't know the infotech sector. And I think it's very important that when you buy an ETF, you don't just buy it based on its name. You need to look at the constituents of the index, which the ETF tracks. And as an example, I remember a few years ago that Meta was reclassified from information technology to consumer services.
Wow.
So people might think, oh, Meta, it's one of the big tech, magnificent 7 companies. It'll be in an infotech ETF. Well, not necessarily. So just check which are the constituents and base your investment decision on that, rather than just buying an ETF based on the name. Because sometimes you'd be surprised either who the constituents or what the constituents are, or secondly, what the weights are of the constituents. We spoke earlier about the China ETF as well. As far as I know, the biggest 3 companies have got by far the biggest weightings in that index, in that ETF, if it's the MSCI China one. And again, that skews your returns. What you think you might be buying based on the name might be very different if you actually look below the hood, the constituents and their weighting. So always do that when you consider an ETF.
All right. Well, there's a question on a company that I'm not sure how closely you look at, considering that it is a junior miner, Copper 360. Can you please explain, why does Copper 360 continue to sell off? I was actually looking at it today. It was down almost 13%. Ricus?
Okay, correct me if I'm wrong on this, but they had results not too long ago. And as far as I know, they are still in the development side of things, and I think they've encountered some development problems. Not a huge issue, but plant being completed. Has the time to do the costs associated with that has been extended, and that obviously then has an effect on your share price. Now, it's not unusual, and it's run of the mill. If you when you're investing in this type of company, it will normally uh, overrun and not be on time, and you've got to live with that. Coupled with that is hopefully your capital investment that you're making today will be paid back once you start your operations by whatever it is that you are producing in this case copper. So it's always going to be a risk, and the bigger risk is, are you going to have enough money to actually start normal operations by the time um, 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 the project is finished, or are you going to run out of money beforehand?
Yeah. And as you're talking about, yeah, those results were about a month and a half ago. Their loss widened by 244%. JP, there's a specific question for you. As a special situation, do you go long potential entrance into an index and go short counters which are expected to exit an index with forced sellers as your catalyst?
Good question. So I don't, but I know a lot of other investors and investment managers do. And specifically some of the banks that help the ETF providers to track an index, they would also have trading desks, and they would also do this, where effectively, if you look at how share prices move and therefore how market caps move, you can anticipate on a quarterly basis when indices get rebalanced, which constituents might fall out because their market cap is too low, and which other constituents have done very well and might be then included in the index. And then the ETFs that follow the index have to either sell the ones that fall out and or buy the ones that are new that get added to the index. And that generally does put pressure on the ones that fall out of the index, and it boosts the price of the ones that get included in the index. Now, the trick is the more people do it, the earlier the movements happen, because you're always trying to be ahead of the competition.
Yeah.
To the point that these days, on the actual day of the rebalance, you don't necessarily see big moves because people have already anticipated a few days ahead or a week ahead or 2 weeks ahead. So you are continuously chasing your tail, and sometimes you can get it wrong. You buy or sell constituents based on whether they'll be added or deleted from an index, and then something else happens which is more fundamental based on what's happening to the company, and then the share price moves in the other direction. So it's a valid strategy, it's a valid special situation, but I don't get involved in that one now.
Okay. Well, gents, let's get to your stock picks for today. Ricus, what are you picking?
The iShare, which is the liquor company, brands like Johnny Walker, Guinness, they've been under immense pressure for a very, very long time. Results recently on the 5th of August. I think what we are sitting with is a turnaround situation. Normally, just looking at it technically, I wouldn't want to be catching a falling knife, but if I take a look at those results, with new management, an increase in cash flow, they've changed strategy rather than just protecting margin. In other words, they really are taking a look at prioritizing what we are selling, monetizing what has really been old stock, and specifically concentrating on sharpening the focus of what I think has really been a company that's been just riding on brand rather than looking forward and saying how are we going to monetize our brands, how are we going to refocus. And specifically on the last set of results, I think downside in this is limited. And Jim Cramer actually said we should sell it yesterday, so we can do an inverse Jim Cramer on that. And I think also the negative press about, shall we say, the developed world, your Gen Z millennials not really drinking, I think that is putting, I think the news is too bleak on that. I really think we are sitting with a value opportunity.
All right. Well, JP, where are you seeing opportunity today?
I'll pick a local share, AVI. So things are tough in the local economy. I don't know if anyone else has noticed, but things are tough at the moment. The middle class is getting squeezed. costs are going up, inflation is up, but raises and salary increases aren't necessarily up that much. So when things get tough, I migrate to quality companies with good management teams that try the whole time to decrease their costs and keep a lid on costs, increase their prices in a prudent way as much as they can, and that are very good with capital allocation. And AVI is one of those companies. Obviously, it's got a food side of the business and a retail side of the business, fashion and footwear. And I think they were almost an acquisition target not too long ago, a year or two ago. And the other thing when things are tough is M&A activity picks up because company can see it's going to be very difficult to grow organically, so they prefer to consider mergers and acquisitions to grow. So because of all these reasons, I think AVI is a high-quality company, not necessarily very cheap, but also definitely not expensive, is a share that one can look at in these tough times.
All right. Well, thank you so much for your time and for your analysis today, gents. Really, really appreciate it. That is all for Stock Watch tonight. Thanks to our guest, Pierre Verster from Protea Capital Management and Ricus Reeders from PSG Hole in Ruimsig. Up next, the close. Stay watching.